Hello, I'm Ryan from Fund Caliber, and today I'm joined by Alistair Wittet, elite-rated co-manager of the Comgest Growth Europe ex-UK fund. Alistair, thank you very much for your time.
Not at all.
There's been a lot of positive noise around European equity markets in recent weeks, as investors seem to think that the EU's recovery plan, the plan to help European countries come through the recession, is a big step forward in the bloc's unity. Someone's gone so far as saying that Europe could outpace the US in the coming years. Is this a view that you share? Are you excited about the prospects for Europe?
I think Europe has responded extremely well to the crisis. And actually, we've seen that as the companies have started reporting their second quarter results. On the whole, they've come in better than feared. And indeed, a lot of focus has been on the current trading, on how June, July has been trading in the first couple of weeks of August. And on the whole, those have also been encouraging. So I can give you a couple of examples of that. Campari, for example, so the company that sells the iconic Campari brand, but also Aperol Spritz. They reported a very resilient second quarter with very good cost control, helped, of course, by furlough schemes. But they've also commented that trading since the end of the lockdown has been very strong. In the luxury space, Louis Vuitton has reported, again, an impacted second quarter, but strong trends in June and July. In other sectors, SAP in the software space, they even reported growth in the lockdown quarter, which is quite remarkable. And maybe one other example of a more cyclical company, Sika, which sells ingredients used in cement, used in the auto industry as well. So very much exposed to cyclical trends. They've reported positive growth in June, and they're expecting a positive growth in the second half of the year as well. So I think what we're seeing on the ground is that, yes, the second quarter was difficult, demand was weak, but costs were well contained, thanks in large part to these furlough schemes, and that we're seeing the demand come back in June and July.
So, and Asia is a big trading partner for Europe. Does the sort of increasing negative sentiment and sort of trade war concerns towards China worry you in any way?
Look, I think there's what fills the newspapers, and then there's what we're seeing on the ground. And again, I have to say there's quite a difference. First of all, yes, China is an important trading partner, but if we take, for example, our portfolio, the revenue exposure we have to China is maybe 5 to 6%. So it's not non-existent, but neither is it a major part of the revenue of the companies that we invest in. And then where we see exposure to China, we really are not seeing any impacts from what seems to be, as you say, kind of increasing negative sentiment. And that's partly because either the companies are selling life-critical products to the Chinese, to China, which they're obviously not going to cut back on. So, for example, Novo Nordisk diabetes care products or Roche's oncology products, or because what they're selling are highly desirable brands that the Chinese people want. And so this could be Hermes handbags. It could also be L'Oreal's beauty products. And indeed, L'Oreal recently reported very strong growth in China, over 30% growth, even during the lockdown. And so that we think that demand from the Chinese consumer for these highly desirable Western brands exists today and will continue to exist.
And currency is obviously a big thing when you're investing in different geographies. The euro itself has done very well of late. US dollar is just starting to show some signs of weakness. Do you think this is a positive or a negative for your holdings and for your investors?
I think it really depends on a company by company basis. So a weaker dollar is obviously not a good thing for your dollar denominated revenues. If you're selling products in the US, then the value of that in euros will have gone down. We're not so concerned about that for a couple of reasons. First of all, that doesn't impact the long-term structural strength of these companies. Where we would have a concern is where there is a transactional exposure, where you're producing your goods in euros and you're selling them in dollars. And so therefore, the fluctuation of the exchange rate can have an impact on your competitive advantage, on your margins, on your ability to sell the products in those markets at a reasonable margin. And we don't have exposure to that for the most part. So the companies we tend to invest in, and the higher quality companies tend to produce and sell in the same market. And then the other reason why we're not overly concerned about it is because a lot of the companies and the better companies tend to have strong pricing power, and therefore they're able to offset the currency devaluations with price increases. And I would note in particular Louis Vuitton, for example, put through a 5% price increase at the end of June. And that will have been in part to offset what they have also noticed, which is obviously this devaluation of the dollar.
And in your portfolio, and you've mentioned a couple of brands already before, but you do hold quite a few brands, in particular I think sort of Lindt and Heineken, two companies that this household knows very well. What is it about these sort of companies that you really like?
Yeah, well, I think in both of these cases, they have quite a few characteristics in common. The first is that they are both high quality and long-term oriented companies. It's not a coincidence that these are companies with very stable long-term shareholder structures. Heineken, in the case of Heineken, the Heineken family is behind it. In the case of Lindt, the Lindt pension fund owns around 20% of the company. So they have long-term stable shareholders, which frees up the management to make long-term decisions. The Heineken CEO just stepped down a month or two ago. He had been in the job for 15 years. He'd been at Heineken for 36 years. And this is extremely important, especially when we're thinking about brands, because brand building is not something you do in a 6, 12-month, or even in a 3 to 5 year time horizon. You build a brand over decades. And so therefore, having a long-term mindset with a stable management team is extremely important. The second thing that unites these two companies is that they are premium players. Heineken, in the case of the Heineken brand, Lindt Chocolate is a premium chocolate, and that affords these companies pricing power. And when we come back to that question you're asking about currencies, pricing power becomes very important. It is your defense mechanism against import tariffs. It's your defense mechanism against currency devaluations. So that is very, very important characteristic. And then the third characteristic I'd highlight true for both of these companies is that they can leverage structural growth trends. In the case of chocolate, chocolate consumption generally is not very strong, and people are being more careful about their diets. But premium chocolate is a category that is growing, and it's growing at around 5% per year. So people are eating less chocolate, but they're eating better chocolate. In the case of Heineken, beer consumption is not particularly strong, especially in developed markets. But there are two areas where you are seeing structural growth in beer consumption, and that is in emerging markets, and that is for premium beers. And of course, these are two areas that Heineken are very strong in. So I think there's a number of characteristics that are true for both of these companies. But I would say behind all of it is their very long-term mindset.
And just going back to the first of those points you touched on, the sort of family ownership structure, is that something you look for in your companies?
It's something that is important, and family ownership is a sort of a double-edged sword. There are many examples where it can prove problematic, but one of the great advantages it brings is a long-term mindset and the ability for management to not worry about quarterly results and focus on building the business for the long term. I think one of the best examples I can think of that is Dassault Systèmes, which is a IT company, a French IT company. They build IT modules to help build a digital mock-up of a plane or of a car or whatever it might be. And the CEO says they have 3 business plans. They have a 10-year plan, a 5-year plan, and a 3-year plan. And the order of importance is those 3. The 10-year plan is the most important plan that they focus on. So I think the family ownership, and of course, Dassault Systèmes has a family behind it. So a family ownership structure generally allows the management to focus on the long term, and that's something that we value.
Thank you. And perhaps a final question. You measure the carbon footprint, sort of the environmental footprint of your funds, as it were. Can you tell us a bit more about why you do this? And are there any other ESG factors you take into consideration when you're investing?
Absolutely. So we do look at the carbon intensity. The intensity of the portfolio is around 82% below that of the index, and there's a number of reasons for that. It's in large part because of the nature of the companies that we invest in. So we tend to invest in businesses that are either in the software space or the brands that we've talked about, or in the healthcare space. So we don't invest in the carbon-heavy industries like utilities, like mining, like materials. So we have a skew, given the sorts of companies we look for, that tends to push us towards companies that have very low carbon intensity. But the reason we focus on that, as we do all the other ESG factors, is because they are, in our view, extremely important to determining the long-term value of these companies. If companies get the buy-in from all of their stakeholders, and that includes employees, that includes suppliers, that includes customers, and of course shareholders, only if the companies get the buy-in from all of their stakeholders do we think that they have a very strong long-term future. And of course, the environment is one of those very important stakeholders.
Well, Alistair, that's been really interesting. Thank you very much for your time today.
Thank you.
And if you'd like more information on the Comgest Growth Europe ex-UK funds, please visit the Fund Calibre website, fundcalibre.com. And for more content from all of our elite rated managers, don't forget to subscribe below.